It's hard to know where to begin with Tishman Speyer. You could go with the numbers. You could say 90 million square feet portfolio with $60 billion in assets under management. You could pick a handful of their trophy properties that they've been associated with over the years, Rockefeller Center. There's so many incredible properties out there. You could try to pick an asset class, life sciences, industrial, multifamily, prime office all over the world. It's fair to say that in most real estate rooms, Tishman Speyer is the 800-pound gorilla. But what I will say about the company is it's a gorilla that's always tried to be nimble, always tried to navigate the times. And so it's a great pleasure for us, The Real Deal, to have Rob Speyer with us today.
Hey,
Rob, thank you so much for being with The Real Deal.
Having me.
We're in Hudson Yards, so maybe we should just start here. You've got an office project called The Spiral, 2.8 million square feet, massive undertaking. It's a Bjarke Ingels design project. What was the thinking behind putting something of that size, of that scale out here?
We wanted to create a different kind of office building, one that was highly collaborative, highly engaging for the companies and the people working there, fully amenitized. And so Bjarke Ingels came up with this genius design to create a private terrace on every floor going up the building in the shape of a spiral. And then I remember one day talking to Bjarke and saying, we should just call it The Spiral.
The Spiral, yeah.
Pfizer pre-leased about 30% of the building in 2018, which allowed us to get going. Who would have known that they'd become like global heroes?
Right.
Couldn't have a better anchor customer in the building. We're now 70% pre-leased.
Yeah.
The building will be done by the end of the year. We just signed the lease with HSBC, which we're super excited about.
And I was going to ask you about that specific lease because it's about roughly 250,000 square feet.
Yes.
But what is interesting about that, even though that is a coup for you, they're downsizing by a very significant amount. I believe they had about twice that space in their old location. So that's a little bit telling, and I think we should talk about that. Major companies still taking space, but the kind of space they need, maybe not as much as before, and that's going to start affecting the value of buildings. It's going to start affecting the value of leases, right? So how do you think about that?
I'll tell you something interesting about the HSBC deal. The unlock with them was our co-working business.
Okay.
You may find that surprising, but we're going to have 2 floors of co-working, about 100,000 feet, that will be very close to where their block of 250,000 feet is. And what we've said to them is, anytime you need to grow, you're going to have flexibility to go into our space. We call that our studio product. And it reminds me of something that happened 5 years ago, which was why we went into that business. About 5 years ago, I was talking to the head of corporate real estate of one of our most important customers. And he said something to me at the time that was searing. He said, WeWork understands us better than you do or any traditional landlord does. They understand we need flexibility. They understand our office space represents our culture. And I thought to myself, wow. So when we lease to WeWork, we are financing another business to disintermediate us from our customer. 5 years ago, we stopped all leasing with WeWork. We launched our own product, Studio. We now have more than 2 million feet of co-working and flexible space across our global portfolio. And here's where it gets interesting. Over the last 2 years, we've done more than 24 deals like HSBC, traditional leases, that we may not have gotten if we didn't have the studio adjacency, where explicitly we've said to the customer, you can grow into that space when you need it.
What about if they want to compress? This is what I'm asking, right? These are companies that when it comes time to renewal, they might be like, you know what? We're going from 5 days a week with 800 employees to 2 days a week. And some employees, there's a staggered schedule. You have to be thinking about that when you look at your global portfolio. You have to be considering that and making some adjustments. So what kind of adjustments are you making?
Here's what we're seeing. Real estate, and there's a lot of focus on new construction. And yes, projects like the Spiral are benefiting right now disproportionately. But it's not just new construction. It's buildings where the owner has been intentional and purposeful about creating a collaborative environment, about creating a highly amenitized product, about being deeply engaged with their customer. Because here's the truth. You're not going to force people to come back. You have to make people want to come back and want to come back again.
I'm guessing you're partnering much more closely now with your tenants. And I heard you banned...
Customers.
You actually banned the word tenants.
Yeah.
Talk about that.
I hate that word.
What's that about?
I hate that word. It's a feudal word.
Okay.
And it also suggests an adversarial relationship. And that's the last thing we want. I was talking to the head of HSBC shortly after we signed that lease. And I said to him, this isn't the end. This is the beginning. And now it's our job to serve you, to make sure your people are happy, to make sure that this ends up being one of the great decisions of your tenure. And so for me, like, that's what you say to a customer. A tenant is somebody that you're looking to nickel and dime, that you're always looking back on the lease to see who has what rights. If we're looking at a lease, we failed. To me, they're customers.
That's it. Talk more about that. What does that mean?
This is, something that has always been at the center of our company, which is treating our customers like they're the most important asset to our company, and thinking intentionally every day about what we can do to make their experience in our building better. Because then their business will be more successful, their people will be more likely to stay, and they'll be more likely to stay long-term in the building.
Talk about how you scale. So you've got this giant portfolio we just talked about in the introduction. How do you scale? How does it help? And how does it maybe hurt? Is there any point where being this giant player in the space can be a detriment to what you guys do?
So we've been on this decade-long journey to diversify our platform. And it started in the residential business, where we did, over the last 10 years, we delivered 9,000 units of residential, and we've signed up another 13,000 units during COVID, about $6 billion of residential investments. We launched a life science platform where we made more than $5 billion of investments over the last couple of years.
You just closed, I believe, a $3 billion fund, which is among the largest, if not the largest.
I think it's the largest dedicated life science fund. And it was a first-time fund, so a very unusual result. But I think there's something very unusual about the platform, which is that we've combined Tishman Speyer's skills and expertise in real estate with one of the great life science entrepreneurs in the world, Ari Beldegren, and his business. So we're offering the best in science, the best in real estate, which will provide both a physical and a social infrastructure in these buildings that will empower the companies that sign up and will empower their people to create life-changing discoveries.
And that's the
really exciting stuff.
It is exciting, and it's also one of those customers, to use your word, that has to be in the office, right? That is a physical requirement to be there.
Yeah, I like to say you can't do a science experiment on Zoom.
You just can't. So we've seen that happen. Some of these tenants or customers are more resilient in that way. I also think there's an interesting strategy you're using where you're building the life science or buying the life science portfolio, but then developing, I don't know if we want to call them communities or mini cities around that. So there's a project, I believe it's with in San Diego, the Padres. Talk about how you're kind of combining this mixed use idea around life science at its core, right? You're essentially using the life science as a magnet, but then building all sorts of things around it.
It starts with a philosophy that people want to live and work in highly engaged environments. And they don't want to feel like they're walking into an office building that is somehow distanced from the community around it. So take, for example, the project we're doing in partnership with the San Francisco Giants, which will be the largest development in the history of San Francisco. Visa's moving their world headquarters. We're doing a lab building. We're going to have great residential F&B. We're building a 9-acre park. It all sits on the bay in San Francisco. And I think the value of each component of the project will be greater because of what's around it and how the interplay works. And I think it represents something we've gotten very good at, which is partnership. When San Francisco Giants, San Diego Padres, Carnegie Mellon, Harvard, when they chose us to be their partner, they did it because they had confidence that we'd be real partners, where we'd be happy to have them sit in the cockpit with us making decisions and shaping their community. We've gotten really good at civic engagement, and I think the fact that we're good partners and that's widely recognized has helped us get into some really interesting projects.
Is there any infrastructure component involved in this project? Because we're talking, what, 1.2 billion odd, right? Is it giant
with the giants, it's super exciting. There's a huge infrastructure component.
Yeah.
We basically have to build a significant horizontal infrastructure, but we're also building our own energy plant.
Okay.
So this is going to be a net carbon zero development.
I was going to get into that.
Which I'm so excited about because it is going to be good for San Francisco. It's going to be good for the environment. And I think it's great for us to be leading, as we have for a quarter century, on sustainability.
But that becomes, sustainability is no longer a buzzword, right? It's now regulated. And then more importantly, maybe for someone who raises so much capital from outside investors, pension funds, sovereign funds, they're starting to ask hard questions about, all right, you've got this massive project. What is your decarbonization plan? What is your sustainability plan? It is no longer just that, thing you tack on at the end of an earnings call, for example. So how is that playing out? And are you thinking about that in a serious way when you design from ground up?
Look, the good news for us is we're not a Johnny-come-lately when it comes to sustainability. Yeah. You mentioned earlier, what are the benefits of being global?
Scale, right.
Well, we've been in Europe for 35 years, and Europe has been focused on sustainability a lot longer than we have here, or frankly, the rest of the world has. And so one of the benefits of being global is you learn a ton if you're paying attention and you're humble enough to learn. And then you can apply those lessons across your portfolio. So we've been applying the lessons of sustainability across our platform literally for decades. And we've evolved and we've learned, and it leads to things like San Francisco that are going to be a great result, not just for us, but for the community that we're building.
So you see something.
That's the key to these big projects. It's not enough for it to be good business. It also has to be good for the community.
So you see something happening in Finland 4 or 5 years ago, and you're like, eventually that's going to make its way to New York or SF or Boston, and then you could start laying the groundwork for that.
Absolutely, and frankly, the same things happen in Asia. A lot of what we've learned, you asked about our mixed-use developments here in the United States, a lot of it are lessons we've learned from being so active in China, where mixed-use development has been essential to the growth, not just of the real estate economy, but to the overall economy.
Yeah. You're in China, you're in India, you're all over the world, but you're a New Yorker, right? You're a born and raised New Yorker. This is the city.
Amen.
Your father has been, instrumental part of so many of the city's sort of evolution and growth into this hub. What makes you most optimistic about New York City today? Forget everywhere else. We're back in the center of the world.
I'll tell you what, I was optimistic about New York in 2020. And at that point, it wasn't a very popular point of view. But as a lifelong New Yorker, as a fifth generation New Yorker that welcomed my family here when there weren't a lot of places to go, what I've seen is through every kind of adversity that could be thrown at New York, we've overcome, and not just overcome, but gotten better. And one of the interesting pieces of feedback that I get from my friends in Silicon Valley is that the place that they are most often losing their young talent to isn't Texas.
Isn't Miami.
Isn't Florida. Isn't Miami. It's New York City. So that's the future. And what's great about New York is we always find ways to regenerate ourselves.
I believe, in a one-year period in 2020, 2021, you spent about $11 billion in acquisitions. This is the height of the pandemic. How have those bets played out so far?
Yeah, I mean, we've done...
Is that right? That number is roughly that?
It is, and I'd take it a step further. We've done now more than $20 billion of transactions during the pandemic, more than half of that in that first year. And again, let's all recognize this has been a really tough period, and so it's hard to talk about business and things that have gone well because so much has not gone well.
But I think we have to take opportunities, right? That's part of it.
And it's our business to keep keep moving forward, and it's everybody's job to keep moving forward. So we've done that.
So were there bargains available in that period? Did you find some great deals because no one would go near them at the time?
Yeah, I mean, I'll tell you one example.
Yeah.
We bought a building in May 2021, a 4-office campus in the middle of Silicon Valley in Sunnyvale. It had been the headquarters of a company called NetApp, and NetApp was moving. So they sold the building to us. We were able to buy it at about 50% discount to the pre-COVID value. And about a month after we closed, Meta reached out and said, we'd like to lease the whole thing.
You're done calling it Facebook.
So they're allowed to call themselves whatever they want. So, and they're a big customer, and I'm calling it Meta.
Okay.
So in November last year, they signed the lease. It was the largest lease in the country in 2021.
And it sends that resonates across the market, or it sends sort of a message of, hey, we're still around. We're going to keep doing business.
Absolutely. And so there's examples of deals like that in the office space, but the majority of the deals we did of that $20 billion are in other areas that represent the diversification of the company. And the good news for us is we began that diversification journey 10 years ago, which set us up really well for this period of extraordinary growth over the last couple of years, whether it's in life science, whether it's in venture capital. We're now a venture capital.
I'm gonna ask you about that, absolutely. But some of these deals, so most of them, we'll see how they play out over time. What lessons have you taken from deals that maybe didn't work so well? So Stuytown is the one that always comes to mind with Tishman Speyer, $5.4 billion. You eventually had to walk away. What did you take from that experience and said, okay, this time we're not going to play that game necessarily?
Well, first thing is you have to be humble enough to learn, and particularly learn from mistakes. And we certainly, as a company, are a learning organization, and I very much consider that fundamental to who I am. So one thing we learned was the importance of civic engagement and the importance of making our connectivity to the communities where we do business a core skill and a core competence of our company. So we've had a huge focus on that. And the results speak for themselves, whether it's the ability to do large-scale projects in San Francisco, San Diego, Shanghai, or here in New York City.
And lower leverage as well. Lower leverage, I'd imagine.
And we've taken a very purposeful, more conservative approach to how we capitalize our real estate. And here's the result of that. We have a global portfolio of $65 billion. And we did, over the prior decade, more than 50 million square feet of development and heavy redevelopment. And during this couple of years, we've not had a single impairment that's forced us into a difficult discussion with our lenders. And that was a direct result of taking a more conservative approach to our financing strategy. But at the same time, while we've taken a lot less financial risk, we've been taking quite a bit of entrepreneurial risk. And that's what's so exciting.
And that makes it fun, too.
And that's what's led to a lot of the changes in diversification that we've been doing.
You mentioned you've essentially become a VC as well. I know you've been spending a lot of your time, personally your time, talking to technology companies, etc. And then you've started becoming quite an active investor in Proptech. You took Latch public through a SPAC that you guys sponsored. There's been bets on Side and many other companies, right? Do you think what's going on right now, Latch, I believe, it started at 10.8. It's like a fifth of that share price now. Do you think this is mostly herd mentality sentiment stuff? Or do you think there are fundamental issues with some of these Proptech companies that we need to look at?
Well, I'm excited. We got into Proptech 5 years ago. We've done now 20 early stage investments in Proptech companies. We've done the 2 SPACs, and we've now closed our first venture capital fund with $100 million of commitments in our first closing and the ability to raise $150 in total. And it all started with a conversation with a good friend of mine, Sam Altman, who's one of the
Y Combinator,
one of the great venture capitalists and entrepreneurs in the world. And I went to see Sam and I said, what do you think? This was 5-6 years ago. And I said, what do you think about Tishman Speyer doing direct PropTech investing? And he said, only do venture if it can be transformational to your business. And so now I look back at the last 5 years, and not just at those 20 investments we've made, which have done extremely well, more importantly, the impact it's had on our real estate, the impact it's had on our stakeholders and our deeper connectivity to them, the impact it's had on our company culture, and the ability of people joining the company to feel like this is a place where they can really innovate and lead to change. So has it been transformational, Sam Altman? Absolutely.
Okay,
we fulfilled that mandate.
But we are in a position right now where most of these Proptech SPACs are under, right? Most of them have had, Goldman Sachs recently said, I think last week, they're not going to deal with the majority of SPACs anymore. You've taken these companies public. Their share prices are now in the gutter. This is not obviously just that company. It is the broader category. How much of this do you think is just sentiment right now? Because the entire stock market is, I don't want to look at my portfolio nowadays, right?
But growth by its nature is volatile. Innovation is volatile. The tech economy is volatile, and we're certainly experiencing that at the moment. But here's what I know about Latch. It's got a great product. Our customers in our residential buildings where we use Latch love it. And so I'm confident its best days are ahead.
Do you think it's going to be, though, maybe more of a focus on business fundamentals now, not just growth at all costs, given what's happened in the past few weeks?
Look, there's always that balance between growth and value. And, I think over any career, you see that pendulum swing in both directions. But I'll tell you, one of the reasons why I'm so optimistic about the United States of America is we have the greatest innovation engine in the world. That's not going away. And I think over decades, that's going to continue to produce great results for our economy and for Americans. I'll tell you what, though, when I think about the dividends that our tech relationships have paid for our business over the last decade, it's been transformational for us. I'll tell you a story because your cameraman is a Pittsburgh Pirates fan. 10 years ago, I was at a board meeting in Europe, and I was sitting next to a guy named Mike Volpe, who's another one of the great venture capitalists in this country. And Mike said to me, "Have you looked at Pittsburgh?" I said, "No."
Former industrial,
Why?
Right? Yeah.
He said, "This may surprise you. There is more AI and robotics research coming out of Carnegie Mellon than out of Stanford. And that's got to have a real estate impact." So we put a team on Pittsburgh, and that team found this incredible project in partnership with Carnegie Mellon and University of Pittsburgh and several other of the important foundations in that city. And we're going to be creating a whole new innovation mixed-use neighborhood in Pittsburgh over more than 100 acres. But it all started with Mike's insight, which is there's incredible innovation that's going to have a big impact on real estate. And I think, to me, I've always found it essential to look outside the real estate bubble to the world around us, because it's the change that's happening outside of real estate that profoundly impacts our industry.
So it often comes out of that idea or conversation. I guess that's some of the reporter in you talking as well, right? Listening,
it's the student.
picking.
It's the student, and it gets back to not letting pride get in the way of learning and improving and evolving.
We start, when you think about Tishman Speyer, you're probably associating it with Rock Center, MetLife Building, prime Manhattan. But you've expanded not only globally, but also in New York City. Long Island City has become a big bet for you now. I believe there's an interesting story to do with that acquisition.
Yeah, that's funny. I'm surprised you know about that. But this all started about 20 years ago. I don't know if the name Bill Modell.
Yes, the sporting goods.
The incredible guy. He was the entrepreneur who created Modell's, and a wonderful, wonderful person. And he was smart enough to buy up a swath of Long Island City.
Whereabouts are we talking?
It's on the intersection of Queens Boulevard and Jackson Avenue. And he was not a developer, so he wanted a partner. And we were connected through a mutual friend. And I met Bill out there one day, and I was looking around, and this area was desolate. but for one thing. That intersection of Queens Plaza and Jackson Ave, it was where the Rikers Island bus let the inmates out every week.
Well, that's pleasant.
So not a trophy location.
Sure.
But Bill said, wait a second, taking you to lunch. And he took me to a great Italian place a few blocks from there, Mandicotti's. And then after lunch, we walked a little further into the neighborhood, and you came upon really nice single-family homes. You came across Citibank's old headquarters. And it sort of dawned on me, wait a second, this site is going to be developed and could be something great, and there's enough scale here to do something extraordinary.
Yeah.
So now I look back 20 years later, what we've created, more than 4 million feet, and not just buildings, but a real community.
I think it's a good time for us to talk about the political environment in which we're building today, in New York, elsewhere, but maybe we start with New York. There's always been this push-pull between preservation and development. Some would argue that it's maybe swung too far in, hey, let's not build at all. Other people would say, developers come in, they just build, they destroy. How do you navigate that? And obviously, we're keeping in mind that it's been quite a progressive left push in the last few years. Real estate had some really, really big defeats in Albany. So how are you thinking about that? How are you positioning your company? And how are you thinking as a leader in the industry about how to make sure that the politics, you have tailwinds, I guess?
Look, in order for New York to keep attracting the next generation, whether it's kids moving here for their first job, whether it's families moving here from other parts of the world to get their piece of the American dream, New York has to be affordable.
Yeah.
We need more housing production.
Right.
We need it at the deeply affordable level, we need it at the workforce level, and we need it at the pure market level. And if we restrict supply, if we cut off supply, that's the best way to send rents up and make New York less affordable, which is the worst thing we could do. So I think we have to come up with a compromise that allows for more housing production. I was very proud to be part of an effort with the former governor, the former mayor, to create a program several years ago that's now expired.
Yeah.
And by the way, there are certainly improvements that could be made to it.
You were talking 421A right now.
The successor, the Affordable New York program, which came after 421A. And you know what? Now we can create another program. And again, there are always ways to improve it. The details are less important than the outcome, which is housing production. We need it desperately, and it is the only way to make New York an affordable place to live, and it's the best way to ensure our future.
What about what I asked about the rise of the progressive left in general?
Look, I'm not a political expert, and there are probably a lot of people better qualified to opine about politics than me.
But 2018 was a big hit for the industry, and I'm assuming for your business as well. So, after that, you're probably thinking about how to position not only your company, but the industry, right? In this political climate.
Listen, the best thing about the real estate industry is we are, through every cycle, the most philanthropic industry in the city. You look at every hospital, you look at every educational institution, religious institution, they're all supported by real estate. And so we know how to be collaborative and engaged, and we need to do that with our political leadership. There's no choice.
Yeah.
We need to have an outcome on critical issues like housing to have a path forward for our city.
You can't pack up and move. Your business depends on being here.
Well, I'm here because in my soul, in my core, I am a New Yorker.
Yep.
I'm raising kids who are New Yorkers, and I couldn't be prouder about that.
I love how food sort of plays a role in so many of your stories. So you talked about Mandicotti's. There's a very famous anecdote from Bagley's book about tuna fish sandwiches, and maybe you were debating with your dad about Hudson Yards at the time. If you were having the tuna fish sandwich in the next generation, sitting with either your kids or the next leader of Tishman Speyer, what kind of conversations do you think you'd be having?
Play the long game. Always think about things in a long, wide arc. Don't just think about a transaction. Think about a relationship. Think about how you can be of service, whether it's to your customers or your community. and think about what you want people to say about you 10 years from now, not 2 minutes from now.